In 1980, silver went from $6 to nearly $50 in a single year. Not slowly, not gradually, in 1 year. And the people who were positioned before that move didn't just make money, they changed their financial lives permanently. But here's the thing, almost nobody talks about. The majority of people who knew about silver in 1980 did not catch that move. They found out after it was already happening. They bought near the top, watched it collapse, and got wiped out. And the difference between those two groups, the ones who made generational wealth and the ones who got destroyed, was not intelligence. It was not luck. It was timing and awareness. And right now in 2025, that same setup is quietly building again. Not as hype, not as speculation, as a structural alignment that has appeared before every major silver move in modern history. And almost nobody's paying attention yet. I want you to feel the weight of that before we go any further. Because what I'm about to walk you through is not a prediction. It's a pattern. And patterns don't care whether you believe in them. They resolve whether you're positioned or not. So stay with me, because this is the kind of analysis that private wealth clients at Goldman Sachs pay $50,000 a year to access. And you're getting it right now for free, while most people are still watching highlight reels. Let's start with the signal that is hiding in plain sight. Right now, gold is trading above $3,100 per ounce. That is a 38% move in 12 months. The financial media has covered it. People know gold is up. But here's what they're not telling you. And this is where it gets interesting. Silver has barely moved in comparison. And that gap, that specific divergence between gold and silver, is one of the most reliable indicators in all of commodity market history. It's called the gold to silver ratio. And right now it is sitting above 88 to 1. That means it costs more than 88 ounces of silver to buy a single ounce of gold. The historical average of that ratio, measured across a full century of data, is 47 to 1. When that ratio gets stretched this far, and I need you to hear this clearly, it does not stay stretched. It has never stayed stretched. It compresses back toward its mean every single time. And when it does, silver does not just go up. It explodes. It moves 2, 3, sometimes 4 times faster than gold did. That has happened in 2003, in 2009, in 2016, and most dramatically in 2020 when silver doubled in 4 months. And right now, we are sitting at those same ratio levels again. Same signal, same setup, same historical precedent. The only question is whether you're going to be on the right side of it this time. Before we go deeper into the mechanism, and I promise you the mechanism is what makes this different from every other silver video you've seen, I want to ask you something directly. Drop a comment below right now. Tell me what time you're watching this and where you're watching from. Because here's why that matters to me. The people who are catching this analysis in early 2025, before this story goes mainstream, are the people in a fundamentally different position than the ones who find it 6 months from now. I want to know who's here early. So drop that comment and let's keep going, because this is where it gets serious. Now let's talk about the number that I know sounds insane the first time you hear it. $900 silver. I know what just happened in your head. You thought, that's a clickbait title. That's not realistic. And I completely understand that reaction. Here's the thing though. In early 2020, Bank of America published a research note projecting gold would reach $3,000 within 18 months. Gold was trading at $1,100 at the time. People had the exact same reaction. They called it unrealistic. They called it hype. And now gold is already past $3,100, and Citigroup has a published target of $3,500 by end of 2025, with Bank of America showing a bull case of $4,000. So before you let the number close your mind, ask yourself one question. What if the people calling it crazy are the ones who will be watching it happen from the wrong side? Because that is exactly what happened to the people who dismissed $3,000 gold in 2020. So instead of reacting to the number, let's understand the mechanism, because this is where it gets genuinely interesting and genuinely alarming, depending on where you're sitting. Silver is not just a monetary metal. That's the first thing most people get wrong about it. Gold is almost purely monetary. Roughly 90% of gold demand comes from either jewelry or investment. Silver is structurally different. More than half of all silver demand today, approximately 56%, comes from industrial applications, and not legacy industrial applications. We're talking about the infrastructure of the future. Solar panels, electric vehicles, semiconductor fabrication, 5G networks, medical imaging equipment. The average electric vehicle requires between 25 and 50 ounces of silver depending on the model and battery architecture. Global EV production is on track to grow from 14 million units in 2023 to over 40 million units by 2030. That's a tripling of one demand source alone. Solar installations consumed 140 million ounces of silver globally in 2022. By 2030, that number is projected to exceed 300 million ounces annually, just from solar, just from one application. Now, here's the problem, and this is the part of the story that the financial media is almost completely ignoring. Total global silver mine supply sits at approximately 820 million ounces per year. That number has barely moved in a decade. And the reason it hasn't moved is structural, not temporary. Silver is primarily a byproduct metal. It doesn't come from dedicated silver mines. It comes out of the ground as a byproduct of copper mining, zinc mining, and lead mining. Which means, when silver demand spikes, you cannot simply decide to produce more silver. You would have to massively expand copper and zinc production first, a process that takes 8 to 12 years from discovery to production. The supply side of this market is structurally inelastic. You cannot turn the tap. So what you have right now is this: demand exploding on one side, supply essentially fixed on the other side, and a price that has not yet reflected that imbalance. That is not a normal market. That is pressure building, quietly below the surface in a way that most people won't recognize until the release is already underway. Goldman Sachs has been publishing increasingly aggressive commodity price targets for the past 18 months. Their 2025 commodities outlook projected copper hitting $15,000 per metric ton, driven by the exact same electrification demand thesis I just described. And here's what matters for silver. The historical price correlation between silver and copper during industrial demand supercycles is approximately 0.73. They move together because they are consumed in the same infrastructure. The same solar panel that uses silver uses copper. The same EV battery system that uses silver uses copper. What Goldman is saying about copper, and they are saying it publicly in writing with their name attached, they are implicitly saying about silver. The silver price target just hasn't been published yet. When it is, the retail scramble will already be behind the move. Now let me layer in the monetary side of this, because silver has two engines right now. The industrial demand thesis is one, the monetary flight to safety thesis is the other, and both engines are running simultaneously, something that has only happened twice before in the last 50 years. The United States national debt crossed $35 trillion in 2024. Annual interest payments alone are projected by the Congressional Budget Office to exceed $1.6 trillion by 2034. To put that in context, $1.6 trillion in interest payments is larger than the entire U.S. defense budget. The Federal Reserve has been in an impossible position for the last 18 months. They need to keep rates high enough to fight inflation. But high rates make the interest burden on that $35 trillion debt increasingly unsustainable. And beneath that tension, something started breaking in late 2024. Treasury yields started rising even as the Fed was cutting rates. When that happens, when yields go up while the central bank is easing, it is called a bond market revolt. And a bond market revolt has one historical consequence above all others. Capital starts moving toward hard assets, toward things that cannot be printed, toward gold first, because gold is the most liquid monetary safe haven, and then toward silver, faster, harder, and further in percentage terms, because silver is accessible. It's the form of hard asset that ordinary investors can actually reach. And when the fear trade hits Main Street, silver is the vehicle. This is not a theoretical scenario. In 2011, when Standard & Poor's downgraded the United States credit rating for the first time in American history, silver ran from $17 to $49 in under 8 months. 188% in 8 months. The conditions today are structurally more severe than they were in 2011. Not comparable, more severe. The debt is higher, the deficit is wider, the geopolitical realignment is more advanced. The industrial demand backdrop did not exist in 2011, and yet silver is still sitting below $35. That gap between where the price is and where the conditions would historically place it, that gap is the opportunity. And it is closing, not gradually. Gaps like this in commodity markets tend to close abruptly. Here is something I want you to sit with for a moment, because it reframes the entire picture. JP Morgan, one of the largest financial institutions in the world, has held physical silver positions in their COMEX vault exceeding 150 million ounces at various points over the last 3 years. Physical silver. Not paper contracts, not futures. Actual metal in a vault. When an institution of that size builds a physical position that large, they are not doing it for a quarterly trade. Institutions do not telegraph their biggest positions. They build them quietly, over time, while the public's attention is somewhere else. And when the position is complete, the narrative changes. The research desk starts publishing the bullish thesis. The financial media picks it up. The retail investor reads the headline. And by that point, by the time it becomes a headline, the institution has already made 60% of the move. That is the sequence. It has always been the sequence. The only question worth asking right now is, at what point in that sequence are we sitting today? And the answer, based on where retail attention currently is, based on where mining equities are priced, based on the ratio levels, is early. We are sitting early in the sequence. which means the window is still open. But windows like this do not stay open indefinitely. Let me show you exactly how the math works on this, because this is the part that changes how you see the $900 number. If gold reaches $4,000, which is Bank of America's published bull case for 2025, and the gold to silver ratio compresses to 30 to 1, which is where it sat at both the 1980 peak and the 2011 peak, you get silver at $133. That's the conservative repricing. Now, what is different about this cycle, and this is a structural difference that has no historical precedent, is the industrial demand base. In 1980, there were no electric vehicles, no solar panels consuming 140 million ounces annually, no 5G infrastructure, no semiconductor fabs running silver-intensive processes. The industrial demand floor that exists today did not exist during any previous precious metal supercycle, which means the historical ratio precedents actually understate the potential move. Because this time, the price doesn't just have to reflect monetary flight to safety demand, it has to clear industrial demand at the same time from a fixed supply base. That is the mechanism behind $900. Not magic, not clickbait. Supply-demand arithmetic applied to a set of conditions that have never simultaneously existed before. And when something that has never happened before meets a market that hasn't priced it in, that is when the moves that people later call impossible actually occur. Now, here's the part that almost nobody is talking about. And I mean that literally. I have watched hundreds of hours of precious metals content in the last 6 months. And this specific data point gets almost no coverage outside of institutional research desks. Because when you understand it, the word warning in the title of this video stops feeling like a hook. It starts feeling like an understatement. The COMEX is the commodities exchange in New York. It is where silver futures are traded. It is where the price of silver is officially discovered. And right now, the ratio of paper silver contracts to physical silver available for actual delivery has exceeded 300 to 1. 300 paper ounces of silver changing hands in the market for every 1 physical ounce sitting in the vault available to be claimed. In a healthy commodity market, that ratio should sit somewhere between 10 and 20 to 1. At 300 to 1, you do not have a functioning commodity market. You have a financial derivative system that is almost completely disconnected from the physical reality it's supposed to represent. And here's why that should matter to you personally. When a market has that kind of paper-to-physical distortion, when there are 300 claims on every real ounce of metal, the system is only stable as long as the holders of those paper claims don't try to convert them to physical at the same time. And historically, under the kind of monetary stress we are currently experiencing, that is precisely what begins to happen. Not all at once, gradually at first, then suddenly. And when it does, price doesn't adjust slowly, price resets violently. Because the paper market can suppress the price signal indefinitely, right up until the moment it can't. And when it can't, the reset is proportional to how far the distortion has stretched. This is not a new mechanism. In 1980, the Hunt brothers understood it. They began accumulating physical silver and taking delivery on futures contracts, pulling real metal out of the system. The paper market couldn't absorb it. Silver went from $6 to $49 in under a year. The government had to change the rules to stop it. The CFTC literally altered margin requirements mid-move to break their position. In 2011, the COMEX raised silver margin requirements 5 times in 8 trading days to engineer a deliberate price collapse from $49 to $32, 5 times in 8 days. Think about what that tells you. It tells you that the regulatory and institutional infrastructure surrounding this market has historically intervened specifically to prevent physical price discovery from running its natural course. And yet, here we are, with the paper-to-physical ratio more stretched than it was before either of those events. Except this time, there is a demand floor beneath the price that did not exist in 1980 or 2011. Industrial buyers, solar manufacturers, EV producers, semiconductor companies need this metal. They are not speculators. They cannot use a paper contract to build a solar panel. They need physical ounces. And their demand is not discretionary. It is structural, which means the suppression mechanisms that worked before are operating against a physical demand base that will simply absorb whatever metal gets shaken loose and then demand more. Now, let me give you the geopolitical layer, because this is the piece that is accelerating the timeline on everything I've described. In August 2024, the expanded BRICS bloc, which now includes Saudi Arabia, the UAE, Iran, and Egypt, alongside Brazil, Russia, India, China, and South Africa, formally began structured discussions around an alternative trade settlement mechanism. Not a new global currency, something more targeted and more immediately dangerous to the current dollar architecture, a commodity-backed settlement layer for trade between BRICS member nations. The IMF has estimated that BRICS nations collectively represent approximately 36% of global GDP. If even 15% of the trade currently settled in dollars migrates to this alternative system, And I want to be precise. This is a process measured in years, not months. The structural demand for dollars as a reserve asset contracts meaningfully. And when dollar demand contracts, the price of real assets denominated in dollars rises. This is not geopolitical commentary. This is a monetary mechanism that has played out every time a reserve currency has faced structural challenge. When the British pound began losing its reserve currency status between 1914 and 1944, British investors who held hard assets, gold, property, commodities, preserved their wealth through the transition. Those who held pound-denominated financial assets did not. The historical parallel is not perfect. It never is, but the mechanism is identical. And here's what ties the geopolitical shift directly to silver specifically. As confidence in dollar-denominated financial assets erodes at the sovereign level, as central banks globally reduce their treasury holdings and increase their gold reserves, the monetary premium embedded in hard assets reprices upward. Gold moves first, because gold is the recognized sovereign reserve asset. Silver follows, because silver is the accessible version of that same trade for institutional and retail capital that cannot efficiently accumulate gold at $3,100 an ounce, but can accumulate silver at $32. And that accessibility, the fact that silver is the entry point for the broad market into the hard asset trade, means that when the retail phase of this cycle arrives, silver absorbs an amount of capital that is disproportionate to its market size. The total silver market cap is approximately $1.7 trillion. The total U.S. bond market is $50 trillion. When even a fraction of a percent of that bond market capital decides to move toward hard assets, the impact on a $1.7 trillion market is not linear. It is exponential. Let me now take you inside what the actually smart money is doing. And I mean this in the most data-specific sense possible, because I'm not talking about Twitter influencers or YouTube channels. The 2024 UBS Global Family Office Report surveyed over 300 family offices managing a combined $600 billion in assets. These are the private wealth management structures used by ultra-high net worth individuals, the people whose capital moves markets before the rest of the world knows what's happening. In that survey, the average precious metals allocation among respondents had reached between 8% and 15% of portfolio value. At 15% of $600 billion, you are looking at $90 billion in capital that has already quietly moved into precious metals exposure. That capital did not announce itself. It did not appear on Bloomberg terminals with a press release. It moved through physical bullion, allocated storage accounts, and selective mining equity positions. By the time it shows up in public market data, by the time a reporter at the Wall Street Journal writes a story about record gold demand, the allocation is complete. And the retail investor, reading that story over morning coffee, is buying the position that the family office finished building 18 months earlier. That is not cynicism. That is a documented pattern that has repeated in every commodity cycle for which we have comprehensive data. And the UBS report is telling us, in plain language, that the smart money phase of this precious metal cycle is already well underway. This brings me to the mining equities, because this is where the structure of the trade gets genuinely interesting and genuinely asymmetric. The Philadelphia Gold and Silver Index, the XAU, which tracks the major precious metals mining companies, is currently trading at a price-to-gold ratio that is approximately 40% below its 25-year historical average. Mining stocks, as a group, are historically cheap relative to the metal they produce. And that valuation gap is not an accident. It reflects the fact that institutional accumulation of mining equities has not yet begun in earnest. The capital is still moving into physical metal and physical ETFs. Mining equities come next. And here is the math that explains why, when they move harder than anything else in this trade. A silver mining operation with an all-in sustaining cost of $16 per ounce earns a $16 margin when silver trades at $32. If silver goes to $64, the cost stays at $16. The margin becomes $48. The metal doubled, the margin tripled. That operating leverage, that exponential relationship between metal price and mining profit, is why the best performing silver miners rose between 1,200% and 2,000% during the 2009 to 2011 cycle, even though silver itself only rose approximately 400%. The equities are the leveraged expression of the trade, and right now they are pricing silver as though it will stay at $20 forever. That is the gap. And gaps like that in markets with the structural setup we're describing do not stay open. Let me now address the Federal Reserve directly, because monetary policy is the accelerant beneath everything we've discussed. And the Fed is currently in a position that has no clean exit. And I want you to understand exactly why that matters for silver. As of early 2025, the Fed funds rate sits at 4.25% to 4.50%. Core PCE inflation, the Fed's preferred measure, is running at 2.8%, above their stated 2% target. The economy is slowing, but not in recession. The federal government is running annual deficits approaching $2 trillion, which requires issuing approximately $2 trillion in new Treasury bonds each year into a market that is simultaneously seeing reduced demand from foreign central banks. And the political environment is one in which the executive branch is publicly and repeatedly calling for rate cuts. There is no path through that set of conditions that doesn't involve some form of monetary accommodation. If the Fed cuts rates, it reignites inflation, and precious metals go up. If the Fed holds rates into a slowing economy, it triggers recession. And the policy response to recession is always aggressive easing, which means precious metals go up. If the Fed tries to hold steady and something breaks in the Treasury market, a failed auction, a spread blowout, a liquidity event, the emergency response will dwarf anything deployed in 2008 or 2020. And precious metals will go up faster than at any point in this cycle. Every door out of this room leads to the same hallway. And at the end of that hallway is a precious metals market that has not yet fully priced any of these scenarios. Citigroup's FX and Rates Strategy Desk, in their 2024 Quarterly Institutional Outlook, outlined the dollar depreciation scenario with unusual directness for a bank of their size. Their central projection assumed the dollar index, currently around 104, declining to approximately 95 by end of 2025, with a scenario path to 88 by 2026 in the event of forced Federal Reserve easing. A dollar index decline from 104 to 88 is a 15% currency depreciation. In dollar-denominated commodity markets, a 15% dollar decline produces a mechanical 15% price increase in every commodity priced in dollars before any supply-demand dynamics are factored in. For gold and silver, as the most directly monetary of all commodities, the amplification above that mechanical baseline is historically between 2 and 4 times the currency move. That is why $3,500 gold by year-end is probably the conservative case, not the optimistic one. And that is why the $900 silver scenario, when you build the full model, dollar depreciation plus industrial demand acceleration, plus ratio mean reversion, plus physical market tension, plus mining equity re-rating, is a scenario that deserves serious analytical engagement rather than an emotional reaction to the number. Now let me give you 5 specific things to track. Not opinions, not vibes, data points. Because this is how you watch a thesis play out in real time without getting shaken out by noise. First, watch the gold to silver ratio weekly. It's published every day on any commodities data site. A sustained move below 80 to 1 confirms that institutional rotation into silver has begun in earnest. Second, watch COMEX Silver Warehouse Registered Inventory, published daily. A sustained decline below 100 million ounces in registered stock signals that physical delivery pressure is building toward a level the paper market structure cannot absorb. Third, watch the XAU, the mining equity index, relative to gold itself. When the miners begin consistently outperforming gold on a sustained basis, institutional capital has moved from metal accumulation into equity leverage. That is the next phase of the cycle. Fourth, watch the dollar index. A sustained break and hold below 100 removes the principal currency headwind that has interrupted precious metals rallies periodically for the last decade. Fifth, watch the World Gold Council's monthly central bank purchase data. If monthly sovereign gold purchases exceed 80 tons for 3 consecutive months, you are looking at an accelerating accumulation phase, one that historically front-runs the retail phase of the cycle by 12 to 18 months. These 5 data points, tracked weekly, will tell you more about where this trade is in its development than anything you will see on financial television. Because financial television covers what has already happened. These indicators tell you what is building. Here is what I need you to take away from everything you've just heard. Wealth preservation in a period of monetary uncertainty is not a luxury strategy. It is not something reserved for the already wealthy. It is the basic financial imperative for anyone who earns in dollars, saves in dollars, and plans to retire in dollars. The purchasing power of the US dollar has declined 97% since 1913. That erosion is not constant. It accelerates during specific periods of debt monetization, fiscal expansion, and geopolitical realignment of reserve currency architecture. We are in one of those periods right now, and the signals confirming it are not subtle to anyone examining the data. Gold above $3,100, silver lagging at a historically extreme ratio, central banks accumulating hard assets at the fastest pace since the 1970s, industrial demand for silver structurally outpacing fixed supply, paper-to-physical ratios in the futures market at levels that have preceded violent repricing events in every prior cycle, the dollar's reserve status being actively challenged by economies representing 36% of global GDP. None of these are isolated data points. They are a convergent signal, and convergent signals in financial markets resolve in one of 2 ways, either with a gradual adjustment that rewards the patient and the early, or with a sudden repricing that rewards only those who were already positioned. In neither scenario does waiting serve you. The $900 silver call is not a guarantee. It is a scenario, the outer boundary of a mathematical model built on documented supply-demand dynamics, historical ratio behavior, monetary precedent, and industrial demand projections that are already in motion. It may take 3 years. It may take 7. It may happen faster than anyone expects if the paper market tension in the COMEX resolves abruptly. But the direction, the fundamental direction established by the mechanisms we've covered across both parts of this analysis, is not ambiguous. And the only rational response to that direction, given where the price is today relative to where the conditions would historically place it, is to position with the asymmetry in your favor, before the obvious, not after it. Because by the time silver is trending, by the time every financial channel is running the story, by the time your neighbors are asking you if you've heard about silver, that is not the beginning of the opportunity. That is the end of it. The people who transform their financial position in this cycle will be the ones who understood the mechanism before the headline wrote itself. And right now, that window is still open. The question is whether you're going to use it. If this changed the way you see what's happening in precious metals right now, share it with one person who needs to hear it before this story goes mainstream. Subscribe if you want to stay ahead of moves like this, and drop a comment below telling me where you're watching from and whether you're already positioned. Because the next phase of this cycle hasn't started yet, and when it does, I want you to already be in the room.